Hi, and welcome to this introduction to health savings accounts. Health savings accounts, or HSAs for short, have a lot of tax benefits and they can be a great way to save for healthcare costs. One of the most powerful ways to use an HSA, as we'll talk in a minute, is for investing for the long term to build up a fund for retirement healthcare expenses. So let's look at some of the basics. HSAs are tax-favored investment accounts connected to what's called a high-deductible health insurance plan. The health plan can be either through an employer or a plan that you purchase on your own through a private insurer or through the Affordable Care Act marketplace. Sort of like with 401ks, HSAs are portable, meaning if you change jobs, you just go through the rollover process and move your funds to the new HSA plan. There is a minimum deductible to meet the what's called the high deductible health plan qualification, and the number changes a bit from year to year, but for 2023, the minimum deductible for a single person is $1,500, and for a family, it's $3,000. Also, to meet the definition of a high deductible health plan, the insurance plan has a cap on how much a person or family spends out of pocket. Again, the limits change from year to year, but for 2023, the out-of-pocket maximum is $7,500 for a single person or $15,000 for a family. There are several advantages to HSAs. You may have heard them called the triple tax advantage plan, or I think just simply you can say it's a real powerhouse. There are three benefits from a tax perspective. One is that the contributions are tax deductible, and this is regardless of whether you take the standard deduction or itemized, because the deductibility is what's called above the line, meaning it reduces your adjusted gross income and results in a lower tax bill. A single person in 2023 can contribute up to $3,850. And for a family account, the contribution limit is $7,750. There also is a catch-up that allows people to put extra money in based on age. For many accounts like 401ks, the catch-up is tied to age 50, but for HSAs, a little bit different, it's at 55. So for 55 or older, an individual account holder can put in an extra $1,000, or if it's a family with both spouses 55 or above, they can put in an extra $1,000 per person, which means the total contribution could tally up to $9,750 for a family. Also, some employers make matching contributions into an HSA, and those matches count toward the contribution limit. The good news for an employee is that match does not count as taxable income, but it's also not deductible. Only the funds that come out of an employee's own pocket are deductible. So for example, a single person who gets a $1,000 employer match would only contribute $2,850, and that would tally up to the total contribution. The second tax benefit of HSAs is the earnings grow tax-free. So that allows the investments to compound over time without having a tax bill. Third benefit is tax-free withdrawals if the money from the HSA is used for what's considered a qualifying medical expense. And we'll look in just a bit at what is a qualified expense. I like to compare different types of accounts and see what the tax benefits are for each. And Roth IRAs get a lot of attention, I think rightly so, for having tax benefits. But let's look at one way the HSA stands out. We'll start in the middle of the chart here. Both Roth IRAs and HSAs have tax-free growth. And also, if the account holder meets the conditions the IRS sets, the withdrawals are tax-free. Also, neither account has what's called a required minimum distribution, meaning that at age 71 and a half, 73, or 75, depending on different conditions, a person does not have to take money out of an HSA or a Roth IRA, and that allows the funds to keep growing tax-free. The big difference is in the deductibility of contributions. With a Roth IRA, the contribution is after-tax money, so the benefits are in the future. But with an HSA, the contribution counts for a deduction right now. So that just helps stack up how HSAs stand in terms of tax advantages. Now, what makes an expense a qualified medical expense, meaning it can come out of an HSA tax-free? There are lots of different things that qualify, and for the full details, please see IRS Publication 502. But just to hit a few high points, you can pay HSA funds toward deductibles, copays, a coinsurance requirement, prescription drugs, some dental and vision expenses, COBRA insurance if you're between jobs and using COBRA as transitional insurance, or long-term care premiums. There are age-based limits, which basically mean that depending on your age, you can only contribute up to a certain amount for long-term care premiums, but an HSA is still a great way to help provide for that need. Also, HSA funds can be used for Medicare Advantage, but not what's called Medigap. And they also can help pay for Medicare Part B and Part D premiums. So there are lots of different uses. While it's a great idea to earmark HSA funds specifically for health expenses, we know life happens. So what happens if something comes up and you do have to spend HSA funds for non-medical expenses? That's where age comes into play. If you're younger than 65, there's a 20% penalty on the amount withdrawn from the HSA, and also the amount withdrawn is taxed as income. For 65 and older, there is no penalty, but the withdrawal is still taxed as ordinary income. A good way to think of it is the 65 and above scenario is a lot like how the IRS treats withdrawals from a traditional 401k or a traditional IRA. Now let's talk about how you can use an HSA as an investment vehicle. Unlike flexible spending accounts or FSAs that employers may offer, HSAs do not have what's called the use it or lose it feature. So any funds left in the HSA at the end of the year stay with the account holder and keep growing. For that reason, it's a great idea, if you can, to just let the HSA funds keep growing and pay for your health expenses out of your regular budget or regular cash flow, if you want to call it that. Again, that allows the HSA to grow and build up a good nest egg for your retirement years when health care expenses tend to be higher. Again, HSA funds can help with Medicare premiums, long-term care premiums, or just the things that happen as we get older and we start seeing the doctor more and having more procedures, maybe taking more medicines. Because HSAs have a long time horizon, meaning they probably will be used far in the future, it is possible to take a little bit more investment risk with those funds for the potential, not the guarantee, but the potential of higher investment returns. This does depend on the amount of risk you're comfortable taking and your various financial factors that affect how much risk is prudent. So for those details, please see a financial advisor. One thing that's really important to keep in mind is we all get busy, especially with job changes. It's hard to track the details, but it is very common to forget about HSA funds and just leave them in cash. To have the best growth long term, you really want to get that invested. So just make sure you think through your investment strategy and avoid leaving all your HSA funds in cash. And some financial institutions have a minimum amount the account must have, maybe $1,000 or $2,000 before funds can get invested into things like mutual funds or ETFs. So that's another thing to keep in mind. There are a lot of benefits to HSAs, but this is not a one-size-fits-all recommendation that everybody should have one. So some key things to look at relate to your individual or family health and also your budget and your reserves. So if you're in pretty good health and don't anticipate having expensive medicines or the need to see a doctor a lot beyond preventative care, a high-deductible plan may work. It may be a really good option. Unfortunately, if you have chronic health conditions or take specialty medicines, that's when the out-of-pocket maximums really can start to add up. We want to consider total healthcare costs, not just the difference in premium, that is a factor, but also look at what your deductible will be with a high deductible plan versus a low deductible, co-pays, prescriptions, and again, the out-of-pocket maximum is a key number. One thing that can really help is using an online HSA calculator. The AARP has a good tool. And if you don't want to visit a site, if you're younger and don't want to visit a retirement site, you can also find them through many financial institutions. But these calculators look at many of the factors we just talked about, like co-pays, premiums, tax effects of an HSA, and then they attempt to show, based on your situation, which may be the most optimal. A final thing to consider is the emergency fund. Something we talk about a lot just in general, that it's important to have 3 to 6 months of living expenses set aside in a safe bank account. Three months of expenses generally for those who have 2 incomes in the family, and maybe more like 6 months if it's a 1 income situation. But especially if you're looking at going to a high deductible health plan that may increase your out-of-pocket costs, that really reinforces the importance of having good reserves just in case an emergency arises. So we hope this video has given a good general introduction to HSAs, and as always, this video is for educational purposes only, and it's not intended to be personal financial advice. If you do have questions about your own specific situation, please contact a financial advisor.